Let's start with the balance sheet. But before jumping right into the meat of the report, let's take a quick look at some of the opening information that you might be tempted to just skip right over, but which can provide some very critical information. Of course, the company name. If you have more than one company, you'll want to know which one you're reviewing, and the type of report we're looking at. In this case, it's a balance sheet. Underneath that's the date. The balance sheet's an X-ray view of the health of your business as of one particular date. The convention is to prepare these reports nearly always on the last calendar day of the month, and we see in this case that we're looking at December 31st. Additionally, over to the left-hand top of the report, you're going to see that QuickBooks has a default format that tells us the exact time and date the report was prepared, which can be helpful when you're printing reports and have several versions on your desk or different versions are floating around the office. It also tells you whether you're looking at a cash basis report or an accrual basis report, and in this case we're looking at an accrual basis report. I'd like to think of the balance sheet as the three O's: what you own, what you owe, and what's left over. In accounting lingo, what you own is referred to as assets. What you owe is referred to as liabilities, and if you take what you own and you subtract what you owe, what's left over is referred to as equity. The assets section of a balance sheet is basically organized in its presumed order of liquidity, or the order in which your assets can be converted into cash. So we start out with what's shown here as current assets. These are the assets that can be converted to cash in 1 year or less. And that includes accounts such as your bank accounts, accounts receivable, or money that you've invoiced customers for, undeposited funds, which is money you've received that hasn't quite made it to the bank yet, money that you've actually earned but haven't yet invoiced your customers for, refundable deposits, for instance money you've put down on a piece of property or for a security deposit. And moving down the report, work in process. In construction, this usually represents the cost of spec homes in process or for other construction contracts not yet completed. As an aside, I'd like to mention that sometimes builders or even accountants like to think of this as inventory on hand, but we'd never want to use the inventory feature in QuickBooks to track construction projects. The report then subtotals total current assets. Then we move on to fixed assets. This is the next major group of accounts that we see on the balance sheet. When you purchase an asset with a useful life of more than a year, and you pay more than a certain amount, in actuality you're purchasing a fixed asset. I usually tell my clients $500, but you should check in with your tax accountant for their guidance, as there's a little wiggle room on the amount to use. The idea is that you're supposed to match up the cost of the item you bought with the benefit or the income that you'll receive from it. So, for example, if you purchased a truck with a useful life of, say 5 years, you'd show the truck as an asset and then expense part of it every year for the next 5 years. We call that process depreciation. So here you see various typical accounts for fixed assets and the amount that's been depreciated for each of these kinds of fixed assets since they were purchased. We see leasehold improvements at cost and depreciation accumulated to date, and the same for office furniture, fixtures and equipment, computers and software, and then vehicles, followed by a total for fixed assets. If this business had any other longer-term assets, such as a long-term note receivable, it would be listed as an other asset following the fixed assets. Then all assets are totaled. Moving on to what we owe. There's a similar philosophy of liquidity going on in the liabilities section. We show the liabilities that require the use of cash in less than 1 year as current liabilities. Trade accounts payable are typically listed first and other liabilities follow, generally in the order of required payment, although that can be a little tricky at times, as various liabilities may have assorted due dates. Examples of these types of liabilities include amounts that are outstanding on credit cards or bank lines of credit, payroll-related liabilities, deposits from clients for work that we have not yet performed, and amounts for which we have invoiced clients, but that we've not yet really earned. This means that we have billings in excess of cost. We then get a total for current liabilities. Bankers like to compare your current liabilities against your current assets to see your current situation. In this case, if this was your company, you show current assets of $189,290.81 and current liabilities of $99,581.90. So it appears that you're well within your means to pay your current liabilities. Let's go on to look at your long-term liabilities, or liabilities due in 1 year or more. We see a note payable on land for $100,000, a small note payable to the owner, and 2 computer leases that, since they're $1 buyouts, are considered to be loans. Our total long-term liabilities combined with our short-term liabilities totaled to $206,910.88. So now we get to move on to what's left over. The equity section of the balance sheet is next. Equity is really composed of 3 elements. First, what the owner or partners originally put into the business. It could be stock purchased or capital contributions. Second, we either add or subtract what the owner or partners have contributed or taken out after their original contributions. And third, we either add or subtract what the business has earned or lost since it was created. Each year's profit or loss is moved into an equity account called retained earnings automatically by QuickBooks on the first day of each year for the results of the prior year. And then the retained earnings may stay in that account, or they might be distributed out to the owners or partners' accounts using journal entries. Now we move on to where the balancing part of the balance sheet comes in. The total assets always must be equal to the liabilities plus the equity. If those 2 numbers don't agree, something is wrong and you'll need to investigate. In our case, everything's fine. The balance sheet balances. An interesting thing to note about balance sheet accounts is that they're ongoing through time. In other words, they may increase and decrease like your bank account or like accounts receivable. Or they may start out small and continue to increase like fixed assets. Or they might start out large and decrease. A good example would be a loan that you pay down over time. In comparison, income and expense accounts start out at $0 each year and nearly always increase their balances throughout the year. We'll get to the income statement shortly. But in the meantime, I'd like to point out that the way your chart of accounts is organized is going to dictate exactly how your balance sheet will appear on reports. I've included some screenshots of the chart of accounts underlying this balance sheet. Just page through the following screens and click on the scroll bar as indicated to see how everything fits together.